All right, we're going to go ahead and get started. Thank you everyone so much for joining us for our webinar today, Retail Media Mythbusters. We're taking a cold, hard look at facts in today's webinar. We're going to bust open some common misconceptions in the retail media industry. A couple notes, this webinar is being recorded. It will be available on our website and on YouTube on Pacvue.com later today. We'll also be emailing out the recording. And also, please feel free to send in questions, send in chats. If you use the little Q&A button at the control panel on your Zoom link, that will start populating questions for us. We'll get to some Q&A at the end, but feel free to just go ahead and get those in as we go through the webinar today. I also know many of you actually submitted some questions in advance, everything from subscribe and save to video to cross marketplace. So we'll definitely be touching on those throughout the webinar today and then in the Q&A section as well. But first, I want to introduce our Mythbusters for today. So if you haven't met me yet, I'm Adam Hutchinson. I'm the Director of Marketing at Pacvue, and I'm naturally a very gullible person. I've been in the ad tech industry for a long time, so I'm pretty good at being skeptical on claims about what we can do with advertising. But when it comes to retail media, this industry is moving so quickly. There's innovation happening every day, new advertising products, new marketplaces that you start to hear the rumors circulate, whether it's on LinkedIn or word of mouth from your friends or from other vendors. So we really want to put some of those rumors to rest today. So I'm super excited to introduce our two speakers for this webinar today. We have Mindy, the Mythbuster Fashaw, who is the Chief Operating Officer at Pacvue, and Riku Laitasalo, who is one of our account directors at Pacvue, and they are both experts. I've learned a ton from them, so hopefully they can bring me back down to earth a little bit and tell us the truth about retail media. We want to go back to the next slide here.
Sorry about that, Adam.
Awesome. All good, all good. So if you don't know Pacvue, we are the enterprise platform for brands, sellers, and agencies to manage their e-commerce advertising. And we do this by combining performance data, cross-platform performance data, and retail media data, along with tools in order to take recommended actions to increase sales, grow share of voice, and improve performance on online e-commerce marketing. We work with some of the leading brands in the industry, from Unilever to Duracell to Nature's Variety. And we also work with some of the large agencies, as well as a lot of independent e-commerce agencies in this space. We work with advertisers of all sizes, and we'll be talking about things across the board, different categories today as well. So a couple topics that we're going to be hitting on, and then Mindy and Riku will be diving deeper in each of these areas, but around how to measure things, quantifying sales, and can you actually drive sales if you can't measure everything? Incrementality, DSP, a lot of rumors around DSP right now, a lot of innovation happening with DSP. And of course, TV and OTT. Is it working? Are people leaned in? Should you be doing it? We'll be covering all of that today. But first, we want to have a little bit of fun. So Amanda is going to be launching a poll here in just a second. And we want to know, which of these myths do you actually believe, or maybe you just want to believe, and see where our audience is at today. And I'll just say, for the record, I actually do believe two of these, but I'm not going to say what they are until the poll closes. So go ahead and get those in there. All right, we'll close the poll in just a second. All right, get those in. Amanda, I think we're ready to look at results. Let's see what we got.
Wow.
Okay. Not super surprised. So I will say, just for the record, and Mindy and Riku, I'm curious to hear you, but the two that are the leading here, extraterrestrials, I actually do believe that. I believe not only are extraterrestrials out there, but they've already visited Earth. I'm dead set on this. And then the last one about the first Amazon Go store being on the moon. It's coming. There's going to be a day where you're taking your Tesla up, plugging it in on the moon, and going into Amazon Go to get a snack. Mindy, Riku, what about you? Any of these you believe?
I'm big on the extraterrestrials. I'm just happy that we don't have any flat earthers in our audience. So thanks everyone for not voting for that one.
I'm big on ghosts. I actually have seen a ghost myself, so I do believe in ghosts.
All right. Why don't we get some juicier myths here? Let's talk about retail media. Mindy, Riku, take it away.
All right. Thank you, Adam.
So as you guys have seen, we borrowed quite a bit from this show called Mythbusters. I was a huge fan of it. So when we started conceptualizing that for this webinar, that was a clear, kind of direction we were headed. So for those who haven't seen the show, kind of the overall flow of today's presentation, first, we're going to introduce the first myth, and then we're going to try to, debunk it or, essentially prove it. And then lastly, we'll kind of confirm or reject whether that myth is true or false, right? So this first one right here, if something is a driver of sales, I can quantify and measure it. So when we first talk about kind of the overall facts around it, let me first give a little bit of a background, a little story. So in my former life, our company was going through this massive project of converting to a new sales and operations software solution. And really the basic idea of it would be, it would better enable us to measure lift based off of promos and other things that you would load into your forecast to determine what impact did that have on your overall sales, right? So when we were going through this, I was on the e-commerce team on Amazon, and it was clear that this entire project, a massive overhaul, was directed towards brick and mortar, or had brick and mortar in mind. And it made sense because that's where the majority of the sales were concentrated. However, the factors that drive sales in brick and mortar, they're a little bit easier to kind of dimensionalize, to measure, quantify. And I think over time, marketers have just gotten really kind of used to this capability, and it's now table stakes where you need to be able to measure whatever you're doing in store. What kind of like payout is that having? And so I think that's where this obsession with measuring everything in e-commerce really stems from. And everybody on the other end of this webinar fully knows that in e-commerce, it's a different animal. There's just so many variables that are changing, impacting sales. Things are way more volatile than in the actual in-store environment. So a lot of what we talk about in this section is kind of geared towards that specifically. So as a caveat to all of this, pretty much throughout the webinar, we're not necessarily, saying that you shouldn't aspire to do something or measure it. But the reason why we think that, this is important is that basically any methodology is a good one, as long as the stakeholders are bought into that methodology. So there's really no one kind of right way to do something, right? It's just working together, aligning all stakeholders, and really kind of aligning on how you want to approach a certain problem or challenge. So don't let the elusive, perfect methodology paralyze your organization in making your investment and growth decisions. So that's kind of the overall caveat for this entire thing. But just laying out some overall facts on the sales growth attribution waterfall, which we'll kind of dive into and explain in a second. It's attributing every dollar of sales to a specific input is the holy grail, right? It's what everybody aspires to. That's a noble chase, but we don't want that to be kind of a detractor of where your company has success and where it doesn't. And the reality is there's really no perfect way to measure it. And that's being driven by human psychology. You can't get inside the minds of all consumers and assess why somebody made a decision that they did. Even if you ask them, we have so many subconscious things that we're doing that are kind of leading to a decision that even if you ask some panel or have some type of survey, you really won't get like the entire truth behind it, right? So like using a personal example, last time you bought something, how much did ratings and reviews impact your decision versus price versus image quality? And even if you say that ratings and reviews are really important, well, was that 70% of the purchase decision, right? And a lot of these kind of subconscious decisions are kind of leading towards that final consumption go or no go decision, and it's really tough to kind of even get out what percent or what. Some components are more easily measured than others. Price elasticity being, a relatively straightforward one. I think anybody who's gone through an entry-level stats course did some price elasticity modeling, pretty straightforward. Some things are impossible, if not very difficult to measure. And then as we talked, sales attribution models can be useful, but you need to know that you use them directionally and also acknowledge that they have limitations. So we wanted to pause here for just a quick second to ask everyone to just quickly think about how your organization measures your sales driver. Is there an obsession there? Are you kind of running in circles, chasing your own tails, kind of understand what inputs are driving what outputs, and overall, how are you approaching this exercise? And think about that as we go through the rest of the slides. There's just a lot of factors to consider. You might have seen this concept before, but this is the sales growth attribution waterfall. And what this really tries to rationalize is the overall impact that all of these factors have in leading up to a sale. And in this example, we have $200 in sales for a given product, and each kind of overall bucket on the x-axis is some type of variable or input that would have driven a purchase decision. And this is just an illustration. Obviously, it's, there's things that we can quantify, things that we cannot. But overall, when you have this many buckets, it's impossible to have kind of an overall like perfect way to measure things because everything is constantly changing. Things are volatile. So when you look at things like in-stock rates, lost buy box, ratings and reviews, all these things are always changing. So even if you wanted to measure one thing and A/B test it, you had to control for everything else, which is impossible. And in these next couple slides, we'll open up a couple of these different segments and explain what they entail and why it's so problematic and challenging to measure any given input. So the first thing that we want to look at is content, right? Content is incredibly important. It's one of the kind of overall fundamental pieces of retail readiness. It's incredibly important to how you show up in search, your overall relevancy, whether somebody buys your product or not. So when we look at content itself, the things that are, in red here are the things that a brand would want to measure in A/B testing. So you have your images, you have your title, you have your bullet points, and all of these are incredibly important to how you show up on site, whether somebody ends up buying your product, all that. So the noble chase here is you want to, A/B test anything in red. However, when you do that, anything in green is also a really important sales driver, right? So at the very top in the green, you have ratings and reviews, you have Amazon's choice, which can change. You have pricing, which is obviously always changing as well with price matching, through the massive marketplace that we have. You have variations, and then on the right, you have, who's winning the buy box. So in order to really get a clean read on what impact did something that you changed in content have, you have to really hold these things constant. For certain products, it's a little easier than others, but when you have all these variables that you're having to measure and look after and kind of normalizing your final analysis, it's impossible to really determine, hey, out of $200, $40 of those came from my content decisions or what I have in content.
Great. And then another bucket that we're going to take a look at is outside influence. So, it's impossible to understand in aggregate and measure in aggregate how outside influence impacts your sales. Obviously, kind of siloed instances you can measure in hindsight, so after the fact, but to be able to measure those perfectly in aggregate and predict them is incredibly challenging. So just looking at a couple of examples here, I think everyone's familiar with the Tide Pod Challenge, and I don't think anybody foresaw an increase in demand related to human consumption on Tide Pods. And then on the right here, I'm not sure if you guys are familiar with the episode. It was in January of 2018. And interestingly enough, I actually led the Amazon sales business for Newell Brands at the time, who owns Crock-Pot. So there was an episode in January of 2018 where a Crock-Pot caught on fire and burned down a house and killed one of the beloved characters. I didn't watch the show, so I'm not super familiar with the details, but he was a father of triplets, and there was a big social media backlash. And Newell actually even considered suing, but instead what they did is they took to social media and they just countered the narrative. And as a result, their sales actually rebounded and increased. And then I'm sure some of you are familiar with, Slick Deals picking up a good price on one of your items and causing just unforeseen demand. Again, in hindsight, some of these things are easy to measure. However, to aggregate and measure all outside influence is really challenging. And when you're looking to plan for next year, it's really hard to say, well, I expect X amount in incremental sales due to outside influence. And then looking at variables that do influence sales and which are measurable and which aren't. First, a disclaimer, this is based on mine and Riku's informed opinions. So Riku kind of gave his background, having worked at P&G. I actually built my career as a financial analyst at Amazon. So I did tons and tons of sales-driven analyses, and then went on to Newell Brands and led their Amazon sales team, where I had to build waterfalls such as this to plan my year. So we do have a bit of background and experience in this. And really the way that we've kind of coded these are, green is pretty easily to measure with a simple methodology. So as Riku mentioned before, measuring the incrementality on sales of price elasticity. So a change in price, that's pretty easy to measure. Same with promotions. You can look at how much your promotions drove for you incrementally year over year in terms of sales. Yellow is possible to measure, but challenging to get good data at scale. And so you likely have to use some directional data to estimate. So, things like variations, as Riku mentioned, I mean, bucketize outside influence and variations and think about the amount of third-party sellers that come in and break variations on brands' detail pages, et cetera. Being able to track that real time on every single SKU, it is virtually impossible, unless of course you're the retailer yourself or have the data from the retailer. So, that's something that you could hone in on a sample set of data and really measure and get some good assumptions around it and estimate, but again, not easy to measure. And then red is really similar to yellow, but it's incredibly challenging to measure at scale. So you would likely need a highly assumptive methodology. Things like brand equity and trust, retailer trust, as Riku mentioned, how do you get into the head of a consumer and say, well, they made this purchase on this platform of my product because they trusted the retailer and my brand, and X dollars was attributed to one versus the other. I mean, it's simply impossible. So myth number one being, if something is a driver of sales, I can quantify and easily measure it. Riku, I'm not going to do this justice, but I think we've busted this myth.
Yeah, I agree.
I have not watched Mythbusters for the audience, so sorry. Okay, so next up, myth number two, incrementality is measurable and is a crucial measure to success. So again, when we think about incrementality, let's talk about the facts. So as Riku mentioned earlier, measuring incrementality is the holy grail for advertisers. I mean, if you could measure perfectly what is driving what, you could be really, really dangerous, and you could really drive, some incremental sales and share for your company. Understanding incrementality enables advertisers to spend where the biggest lift is for your business. So as I just mentioned, if you knew what drove the biggest lift for your business, you could probably double down on your investments and drive some really good sales and share for your company. Another fact, there's no perfect way to measure incrementality, since purchasing decisions are psychological and often impulsive. So as Riku mentioned before, you as the consumer might not even understand what actually caused you to make a purchase. So being able to measure what you would have done otherwise is incredibly challenging. And then as we mentioned, and this is similar to the sales attribution waterfall, some components are more easily measured than others. So when looking at incrementality by itself, incrementality itself is not a myth, but the idea that it can be measured precisely is the myth. So looking at things like how incremental is my e-commerce channel or my e-commerce advertising. I think everyone knows that Amazon has surpassed Google in terms of the percentage of shoppers who start their product research or their product shopping journey on their site. So according to a June 19 eMarketer report, more than 2 times the number of shoppers are actually starting their product research and product shopping journey on Amazon over Google. But how much of that is actually being converted on Amazon versus converted, offline in brick and mortar stores or on other retailer websites? And that's really what's challenging to measure. So really what incrementality is looking to measure is, what would the shopper have done if you didn't advertise or if they didn't see your product?
So when we're looking at this entire concept of incrementality, we wanted to introduce some ways in which we've seen this challenge tackled. So this is probably one of the more common approaches that we've seen. It's a share of voice based model in which you're looking at search results and figuring out from there, what's the probability that somebody would have bought your product had you not advertised? And a way to visualize this on the right is, if somebody's searching for the word protein bar, what organic presence do you have, right? And you can see that there's 9 organic results for the brand Premier Protein. So the probability that somebody would have been able to find your product if you hadn't advertised, quite high. But the thing to really kind of differentiate here is the organic listings are all for $6 to $7 price point items. and the things that this brand is promoting are $12 to $13, right? So the incrementality might not be so much that they wouldn't have bought your product, but it's how much would you have generated for that transaction, or what's your basket size. And you can see that the incrementality, it's probably not 100, it's probably not 0, but it's something in the middle. The difference between the $12 or $13 basket size versus the 6 that you would have gotten organically, right? And that's one of the limitations we'll talk about in the next slide. Is oftentimes incrementality is a yes or no type answer rather than, or from what we've seen in the methodologies, whereas the answer is more somewhere in the middle. It's a little bit murkier, it's a little bit more vague. Some limitations with this share of voice model, we'll go through 4 kind of big buckets, the things that they kind of miss out on. So even though they're the most popular, they're not really kind of capturing the entire picture from what we've seen. The first key limitation, browse-based shopping. On Amazon, you can get a really good sense for incrementality based off of a share of voice model. However, on some of these newer platforms, browse-based shopping is way more popular. On Amazon, roughly 95% is from search, if not higher, right? So it's a spearfishing website. Whereas something like Target, from some of the data we've seen from the Target team, up to 60% of all conversions come from browse-based shopping, and it depends on the category entirely. But if your entire share of voice model is just around search, or sorry, your incrementality model is around share of voice and search, then you're missing out on 60% on some of these platforms, which is a pretty big miss. Then what about sales that come from an annuity after a shopper already engaged with your ad, right? So if that shopper clicked on your ad, but now buys that product from a past purchase list or even SNS or subscribe and save, do you consider those purchases incremental, right? And how do you factor in this kind of overall customer lifetime value into your incrementality methodology? I haven't seen a good answer for this in any of the methodologies I've seen. We also talked about the price differential in the previous slide, the $13 basket with paid versus the $6 to $7 basket with organic. How do you factor that into your incrementality exercise? There's just a ton of data that would be needed to really run kind of a robust and effective incrementality model, which, as we're kind of explaining, is kind of the holy grail. It's the kind of like the chase that everybody's after, but is it feasible? We don't necessarily think so, especially with this last limitation here, which is platform nuances. The key example of this is how Instacart treats paid versus organic. So for context, Amazon, as you guys know, if you have an organic listing, you can also boost that same product to the top of paid or somewhere else in the first page of results. So you can have a paid and organic on the same listing. Whereas on Instacart, if you were going to show up organically, but instead you invest in paid search, that organic result is now a paid result. So to measure, that whole concept or measure, that whole dynamic, it's impossible because you don't have the Instacart data on whether something had a chance of serving organically. All you can do is observe if it showed up paid versus organic. So this whole kind of challenge is I think it's going to be even more present on some of these new platforms, depending on how they approach it. Can you have paid and organic, or is it just one or the other? And then lastly, even if you were able to kind of measure that on a platform like Instacart, think of all the thousands of zip codes, think of all the stores that you'd have to monitor, you'd have to look at all these keywords, just so much data that, we haven't seen a scalable solution for it yet. And then we also wanted to pay lip service to a couple of other approaches that we've seen. On Amazon, they provide new to brand data. Right now, it's available for sponsored brands, which in itself is a limitation. Most brands spend way more on sponsored products. So just looking at new to brand as a kind of a heuristic or proxy for incrementality has its limitations by default. Sponsored product new to brand, they were beta testing it. They've since walked that back, and our NETA is unknown at this point. But the whole idea behind new to brand is you're looking at shoppers who haven't bought a product from your brand within the last 12 months, and you're assuming that those shoppers are incremental. And it's pretty straightforward, right? I mean, it's a pretty basic ratio. There might be some nuances to how manufacturers or advertisers look at that new to brand. There might be a little bit of a nuanced model, but it makes more sense in CPG because the purchase cycle is more frequent. You might be buying a product every 2 to 3 months. So the incrementality as a proxy might be a little bit more in line with how you look at the business versus somebody who's selling TVs and consumer electronics, right? The purchase cycles could be about more than a year. So technically, every time somebody, even if they're a brand loyalist or have bought your product before, they look like a new user, it would kind of skew your incrementality data that way. But even with this approach, we're not really getting to kind of the heart of the question around whether you would have gotten a sale if you didn't advertise, right? We'll show an example here in a couple slides on the ways in which we think about incrementality. But new to brand, it's simplistic, but obviously there's a lot of limitations, accuracy being one of them. The next up is, it's kind of the hot one, MMX modeling. It's where a lot of the bigger brands are headed right now. So we're starting to explore these models and providing our POV. Really, the nut of it is that, or the net of it is that it's looking to assess if you have media spend in whatever channel, in e-commerce specifically on this one, what's the overall kind of impact in the greater market of that, right? What kind of lift are you expecting from your total sales, all outlets considered? And since Amazon and other e-commerce platforms, as Mindy said earlier, are where consumers go to do their product research, this drives offline sales, right? So they're looking to understand, what is your media spend doing in terms of driving offline sales as well as online sales? So these models really are a warm welcome, but they're very much in their kind of nascency at this point. So we're looking to understand how we can better use these types of models. And since there's so much complexity, so many data points are needed to run these, they can be pretty cost prohibitive for some of the smaller brands, for example. They're done by companies like IRI and Nielsen, some of the big heavy hitters. So they'd be the ones who you should go to for that.
Great. So little reality check here. So, the question is, as Riku mentioned, a lot of this would be really challenging to measure. And, do you have the right technology, data inputs, and capabilities to execute against this data? So really, even if you had the perfect data, what would you do with that? Would you be able to influence your organization to make different funding decisions? Would your organization be willing to go dark, like truly go dark, to measure incrementality? And even that, is that really a perfect measure, given that, this is all auction-based, paid search is auction-based, and so is display, quite honestly. And so the landscape is changing minute by minute, second by second. So even with that perfect data and going dark and measuring the impact, does that measurement always apply to the future landscape? So as Riku mentioned, this is a slide that we typically use to orient advertisers in pairing the right KPI to the right business objective. So when we talk about incrementality, as Riku mentioned earlier, we typically recommend, new to brand. Now, the reality is it's not perfect. It's also not entirely accurate. They might be new to your brand on that given retailer's platform, but not new to your brand overall. So is it really incremental, or did they just choose a different retailer in which to make their purchase? So these are all, questions that need to be asked. And the reality is, there's not just one KPI per business objective. It's really triangulating, a handful of KPIs to make sure that things are moving in the right direction. But the key takeaway is really that, it's not that incrementality can't be measured. It's more of a matter of, how does your organization want to measure it? Because as Riku mentioned at the top of the presentation, getting stakeholder alignment is critical, because if your stakeholders are not aligned on the methodology, on the inputs, then they won't be aligned on the outputs. And that data is essentially useless, if your stakeholders aren't aligned and you're not able to leverage it to make informed business decisions. So, this is something that, when I first went to Newell back in 2015, that was right when Amazon had opened up their paid search self-service capabilities. So we were actually a beta partner with Amazon and giving them quite a bit of product feedback in the early days. And I just remember everyone kept asking, how much of this is incremental? If I give you an incremental $1, how much are you going to deliver in incremental sales? And the reality is, there isn't an easy way to answer that question. And so I had recommended coming up with an internal methodology, but honestly, we just couldn't get buy-in on it, because everybody wanted that perfect incrementality measurement. And the reality is, I think brands are still trying to figure out today what that is.
So we get the question on, how does Pacvue think about incrementality? So we try to steer the conversation away from fixation on the perfect way to measure it, and instead kind of rely on these heuristics or kind of ways of thinking about what's more incremental than others. And they're kind of just more so tailored or geared towards understanding what are the actual strategy tenets that you can execute upon that's going to drive top line sales, grow share, whatever your brand objectives are. So this is more how we think about it, right? So we're not there to necessarily come up with the perfect metric or way of measuring it, but we actually do work with clients on that. but more so like, what can you do that looks more incremental than not doing that thing? And a perfect example of that is, let's just say your brand is personal right here, and you have a shopper who searches for a branded term. The chances of that person buying one of your products is quite high, right? But we've talked a lot about this whole discrepancy between price points of paid versus organic. So that's really where we fixate or kind of like focus our efforts, is understanding how can you use that traffic strategically. And since they're brand loyalists most likely, or have at least bought into your value prop as a brand, they're more likely to try products with lower ratings and reviews. Products that maybe don't show up as high organically, boost those to the top, really kind of, jumpstart those, get them higher in search, and kind of use that traffic strategically. So that's really how we think about incrementality, is looking at a specific consumer and understanding how you can deploy a certain set of strategies to maximize the value of your investment. A perfect example of there is driving regimen, right? So we know that if somebody searches for your brand, were they going to buy a fabric softener and dryer sheets in this example? Maybe, but maybe not. So the fact that we're promoting all three of those, that looks, more incremental than had we just promoted, different variations of that same ASIN, or even, pods versus liquid. So that's kind of how we think about incrementality.
Yeah, and one of the things I would add here is, any good paid search strategy is really a portfolio of micro strategies. Obviously, all of which are geared toward getting the best return on your investment and getting incremental sales. And so to Riku's point, you can measure in these micro strategies, but the tactics are different in each. So I think the key takeaway is bubbling that all up into one perfect metric or measurement is the challenge.
So myth number 2, incrementality is measurable and a crucial metric to success. I don't know about you, Mindy. What do you think?
I think we busted that myth.
Yeah, I think so. All right, myth number 3, DSP isn't right for my business. So we're going to change it up just a little bit on this one. We normally start out with the facts, but within DSP, we've really kind of seen or observed that there's a lot of common myths around it, right? So we're going to talk about 4 specific things, and then Mindy's going to kind of show you how we think about each of those kind of counter arguments. So the first one is, I only need paid search to reach my target audience, meaning you can really target upper, mid, and lower funnel shoppers with paid search. Mindy's going to address that here in a second, but that's one of the common things we hear. Costs are significant, right? So we hear that spend thresholds are too high to even get started. Next up, media investment is seen as a conversion driver, especially if they're funded by trade dollars rather than, brand or marketing dollars. So what they're saying is, I get a better ROAS on paid search and it drives conversion. And then lastly, Amazon has really kind of, bolstered their sponsor display capabilities recently. And with those new audience and targeting functionalities or capabilities, what we're hearing is that they don't really have to rely on DSP so much, right? They'd rather just invest via paid search, DSP, or sorry, sponsor display rather than go into DSP.
Great, thanks, Riku. So this here is how we kind of orient advertisers and how to think about new platforms. And so when you think about the Amazon DSP platform, so there's multiple just demand side platforms, which we'll talk about in a second here, but specifically the Amazon demand side platform is the one that has self-service access. And so, we're connected programmatically. And so we'll base a lot of the conversation on Amazon. However, we do expect to see other platforms open up in the future. So when considering any new platform, whether it's paid search or a demand side platform for display media, it's really important to consider these 6 factors. I think the most important one is size and scale. So is the retailer's audience material to my company? I think that's the most important factor. And if so, then continue on and determine if it's worth investing your dollars. So how sophisticated is the platform? Can it help me deliver on my business objectives? And does it have the robust set of capabilities that I need? Are my competitors there? Is there an opportunity to more meaningfully engage with the retailer in more of a JBP relationship? Does this unlock other opportunities for you with the retailer by investing in some of their self-service advertising capabilities? Obviously, sales growth. Does it enable sales growth? That's probably even bigger than does it reach your audience, but those two go hand in hand. And then lastly, is this retailer a good fit? Is my company already working with this retailer, or do we have the ability to work with this retailer? So looking at DSP, so DSP stands for demand side platform. We leverage that term with respect to display media. So essentially Amazon has named their self-service display media platform Amazon DSP. So when we refer to DSP in general, we're really speaking about display media. But we also talk about Amazon DSP, which refers to their self-service platform. So, this is just a quick look at what the current landscape looks like from a retailer perspective, where there's self-service capabilities and where you can work directly with that retailer or their provider to do display. So right now, Amazon is really the only one with self-service display media capabilities. And Pacvue is plugged in programmatically. And then just a quick look at really what is display and how does it differ from search. The key differences are really in the targeting capabilities. So you can see across the top, search is a combination of keyword and audience targeting. So heavily based on keywords with Amazon sponsored products and sponsored brands ad types. But they have recently launched, they launched a couple years ago, but they've really grown their offering around sponsored display, which does leverage audience-based targeting. However, display is really just based on audience-based targeting. So, search allows you to drive increased engagement and conversion with a shopper who's arguably already in market and already a bit lower in the funnel because they're searching for specific keywords around the product. Whereas display, it really enables you to define your audience and target both, your advertising and tailor the creative to target that specific audience. Cost model is also different. So search is cost per click, where display is a CPM model. And then lastly, available placements. So, search placements arguably are lower funnel. They're in search results, they're on product detail pages, et cetera, where display can be seen in various places, which we'll actually talk about right here on this slide. So Amazon display can be shown on Amazon owned and operated properties, such as Amazon, Twitch, IMDb, et cetera. But it also can be shown on third-party publishers. So, if you ever looked at a product and then you're, reading a news article and that product appears, in the middle of your article as you're scrolling, that's really, a third-party or offsite display ad. And then looking at the targeting capabilities. So we won't go into details here. There's lots of different targeting options. But with Amazon display, you've got the Amazon audience, and then advertisers also have the ability to bring their own audience, whether it's through a DMP or a CRM match. So looking at Amazon search versus display, or Amazon search plus Amazon display, really, and this is coming from Amazon advertising, customers that are exposed to both Amazon display and sponsored products ads are 5 times more likely to purchase than those who are only exposed to sponsored product ads. So when we talk about search versus display, it's really not about one versus the other. These are very different tools and they're used for different things, all with the goal of acquiring new customers and growing incremental sales. However, these are definitely better used together and, should not be considered as, mutually exclusive products. And just to take that a step further, looking at the funnel. So, if you're talking just paid search, top of funnel is really kind of that top of search results. But, not every consumer starts their shopping journey by searching for a product. As Riku mentioned earlier, some sites are more browse focused. And so really the funnel starts with, the consumer might not even know that they wanted to buy this product, right? So they're just online. And then they start to get served an ad, and that's where you start to bring them into the funnel. And that is really done better with display media, which you can see on the right side. That being said, there are some upper funnel capabilities with sponsored display through the paid search set of products as well. So again, it's really just about making sure that you understand your business goals and objectives, what products are available to you to accomplish those, and then how do you best leverage those together to have a full funnel approach. And then in terms of costs, so historically, cost may have been a bit more of a barrier to entry than it is today. But, as I mentioned, partners like Pacvue, there are other partners out there that plug into Amazon programmatically for Amazon display for self-service capabilities. And through this new model, partners are able to offer, lower cost than say an Amazon managed service relationship that a lot of advertisers have leveraged in the past. So, Amazon charges a platform fee. They charge a standard platform fee, which they do give partners such as Pacvue incentives. So they will give us platform fee discounts that we do pass on to our advertisers. Also in general, just Pacvue specifically charges lower management fees. And I think that's kind of industry standard for any Amazon partner agency that's doing either self-service or managed services is really what we're focused on. Display is, charging a lower management fee than Amazon's 15% fee. And then lastly, lower spend threshold. So historically, Amazon's been very gated in giving self-service access or accounts to advertisers. And part of the gating has been through their spend requirements. Opening this up to partners, partners really set those spend thresholds. And so likely working with an Amazon partner, there are lower spend thresholds to get self-service and or managed service access than there would be working with Amazon directly. And then Myth, DSP is a transactional tool. So, as we've kind of alluded to in some of our previous slides, but haven't said specifically, ROAS is really not the only metric that matters. And especially when you're talking about display, display is a little bit more of a longer consideration vehicle. If you think about the example I gave where, if you're searching already on a keyword, you likely have a stronger purchase intent than if you were just, browsing around and came across an ad and then clicked into that ad. And so, that consideration period is different between those two activities. And really an immediate return on ad spend shouldn't always be, obviously it's everyone's hope. And it would be amazing if that were the case, but display is really used to drive more brand awareness and meant to be more upper funnel, bringing in new to brand customers, and also, being able to target customers who are in market or already searching for similar products. Maybe they just haven't experienced yours yet. So, ROAS should really be used as a guardrail. Again, I mentioned earlier, leveraging a set of data points to triangulate the efficacy of your advertising investments is really critical, because if you get too honed in on one and you're not seeing the results, you could be missing opportunity.
So this next myth is sponsored display is an alternative to DSP. And we don't want to say that it's an alternative. It's more complementary than anything, right? So we have these things that DSP is better at. We have these things that sponsored display is better at or best at. So we'll talk a little bit about those differences in the slide. So within DSP, fantastic for bringing offsite traffic back to Amazon, right? That's kind of the core use case, kind of regardless of where they are, whether it's more like in market or even retargeting. The top features, there's just a lot more, flexibility with what type of creative you want to run, whether it's video, whether it's dynamic. Targeting options are pretty much limitless. And then use cases, really offsite prospecting and retargeting, as we mentioned. Kind of pivoting to sponsored display, that's really where Amazon has placed a good amount of resources, and they're trying to build that up quite a bit, I think, to make a lot of these things that formerly were within DSP more accessible for maybe smaller advertisers, right? One kind of key change that we're seeing that they're rolling out is previously sponsored display was purely on a cost per click model. And now, they're starting to give advertisers the opportunity to flip that to a CPM based model, which is more in line with what you would see on DSP. But really where sponsored display shines is on detail page targeting, right? It's on site. And what we mean by that is if you're looking at any detail page, whether it's your own or your competitors, or even maybe an adjacent product, it really enables you to, at scale, target specific products, target specific categories, and you can use these pretty cool filters based off of price point. For example, if you have a $10 item, you could target anything in the category that's above a $15. If shoppers are elastic, if they're responding to lower pricing, great way to drive conversion. Conquesting, meaning if something that has like a less than 4-star rating, you could target your product or that detail page with your 4.5 star, shoppers, like, higher rated stuff. We all do, more trust there. So really the use case for sponsor display, it's running the core retail fundamentals, trading up, so larger basket size, trading across, as we showed earlier in the personal example, where, if you're a laundry detergent, perhaps promoting something in like fabric softener or even dryer sheets, for example. And then one of the kind of last myths here is, I don't actually sell anything on Amazon, so DSP is irrelevant to me. And it's really important to understand endemic versus non-endemic. Endemic just simply means your brand is actually selling products on Amazon, whereas non-endemic means, you're maybe a car manufacturer or insurance provider where you don't actually have a product to sell, but you can still leverage DSP to target specific audiences. So obviously, like, the thing that first comes to mind is, okay, well, I'm a seller, I'm a brand, I sell things on Amazon, perfect, DSP is great for that. But I think what a lot of people miss out on is, even if you're not selling anything, DSP can be an incredibly powerful tool for reaching specific audiences, especially, given the kind of overall traffic growth that we've seen on, in e-commerce or retail media in general. So I don't know about you, Mindy, but I think myth number 3, DSP isn't right for my business. We put a pretty strong case forward where I think that is busted. All right, last myth. I don't need to invest in OTT because I'm already investing in TV or linear programming. We're starting to hear a lot about OTT. It's been a thing for quite a while now, but what OTT simply means is it's anything that's on these on-demand platforms like Netflix, Prime Video, something that is completely in contrast to linear broadcasting, for example, cable, where you're bound by pre-planned programming and geography. On the right, you see this entire ecosystem mapped out, and it's super complex, right? The center part of it is the viewer, and as you kind of go out, you have the content providers, you have the service providers, and then you have the devices on which consumers can actually, consume this entertainment or media. And there's just so many options, and the content is constantly growing. It's becoming increasingly more complex. But what Mindy's going to talk a lot about in this section is why OTT is important because of consumer shifts. So starting out with kind of just overall, like, some higher level facts around OTT. OTT is growing fast, and that growth is really being fueled by a fundamental shift in how consumers are consuming media and entertainment. One of the big things there, it's sped up by younger demographics having more spending power, but you also have kind of, investments being made into, how these streaming platforms are putting content forward and kind of, engaging those audiences. The thing that we really like about OTT is the sales attribution data is way more, superior to what you get in traditional national media. So for example, if P&G wanted to test out a specific commercial in a geography, right? We would run that commercial there, then we would have to wait for Nielsen data to see was there an actual lift in that market, whereas the OTT data is going to be, more instantaneous. You can get way more refined and granular with what kind of audiences you're targeting as well.
Great. Sorry, I accidentally double-clicked and skipped ahead for a second there. So thank you, Riku. As Riku mentioned, the growth in OTT is astounding. In fact, last night, I just happened to scroll across an article where Trade Desk has just announced that their Q2 earnings, and they saw 101% revenue growth for Q2, citing a 50% increase in connected TV advertisers. So again, those are the ones that are using things like Hulu, Prime Video, et cetera, and not linear TV advertisers that are using things like cable. So if you look at the chart on the left here, this is an eMarketer chart, and this is really highlighting, if you look at the blue line, in 2020, 24.1% of US households were seen as cord cutters, so no longer paying for linear TV, and really starting to leverage more of those connected TV opportunities. They're projecting that this will grow over 11 percentage points by 2024, reaching 35.4% of US households that are cord cutters and not using linear TV anymore. And then the chart on the right is really just showing that crossover. So the linear or traditional paid TV households is the black line, and then those connected TV viewers is the red line. And really, it looks like connected TV will exceed that of linear TV in 2024. So, according to TechCrunch, the pandemic really accelerated cord cutting and made 2020 the worst year ever for pay TV. And as you can see from these charts, that trend is really expected to continue. And then looking at TV viewer growth in the US by age on the left, you can really see, looking at 2020, you did see an aggregate and increase. I think we all know people were spending more time at home. So by default, COVID is a bit of an outlier or causing this outlier in 2020 when you really look at that trend line from 2019 onward. But as you can see in 2021, which is expected to continue, actually across all age brackets, we're expecting to see a decrease in the viewing of traditional TV. And then on the right, this is just another kind of look at similar data. This is looking at Amazon Fire TV by age demographic. The top line is the total bucket that encompasses the middle row. But the key takeaway here is if you look at that middle row, 22% of Fire TV users ages 18 to 34 are considered either cord cutters or cord nevers, meaning they never subscribe to linear TV. And then looking at OTT as in terms of reach and capabilities. So on average, 74% of the intended audience reached by Amazon OTT ad campaigns were not reached by linear TV advertisements. So, it's just really interesting. This truly is reaching audiences that TV advertising isn't reaching. And then on the right, just looking at targeting, this is essentially saying that, targeting based on behavioral signals only versus combining demographics and behavior is much more effective if you're simply looking at behavior, driving an increase in consideration compared to those that are just using demographic data. So again, the reach and capabilities on OTT is so much greater than linear TV. And clearly, TV viewers are moving in the direction of more connected TV over linear TV. So Riku, myth number 4, I don't need to invest in OTT because I'm already investing in TV. What do you think about that one?
I don't know, you put a pretty strong case forward. I'm gonna say busted.
Shocking. All right, well, thanks everyone for joining us today. I'm going to kick this over to Adam, but I just want to end with, the key takeaway is that we're not trying to discourage people from trying to measure all of these things and trying to get smarter and more robust in how they're, targeting users and leveraging advertising products. We really are just trying to encourage some critical thinking around how do you measure this stuff? And once you have that measurement that works for you and your internal stakeholders, what do you do with that information? How do you leverage that to gain alignment and really drive toward your business objectives together?
Riku, Mindy, busting myths left and right today. I love it. Definitely earned your lab coats today. We've got time for a couple questions. Let's just get to those real quick. Julie is asking, what sort of KPIs should we be looking at for browse-heavy platforms?
Yeah, I can take that one. The metrics are pretty much the same as what we would have, on non-browse-based behavior. So it depends on what your objective is behind your advertising, right? Is it awareness at that point? You want impression volume? Are you serving relevant ads? So click-through rate is, are you looking to convert, conversion rate, ROAS, things like that. So it's kind of the same stuff as what you would want to be looking at on non-browse-based heavy platforms. But yeah, and the data is actually pretty good. So like on Target, you can get performance based off of kind of where those advertisements are. Even on Walmart, you can get those. So pretty much the same.
Great.
And actually, if I could just add to that, I would take that a step further and say, specifically on Target, and we may see this on other retailers, because Target doesn't own their paid search inventory, they farm that out to partners, third-party ad platform providers. There are different ways to kind of test and learn and measure the impact on KPIs, because some of their platform providers use item-based targeting, where others use keyword-based targeting. So that is one area of opportunity when you're speaking about measurement. You might want to test and learn on one or more platform to understand what is the right approach and how does that impact those KPIs.
Great. Okay. So Manuel is asking, how do you understand or calculate lifetime value via subscription models?
Yeah, I'll take that, or I'll take the first shot of that one, Riku, and then you can kind of clean it up for me if you want. I mean, the reality is it's incredibly challenging because to really understand customer lifetime value, you really need access to customer level data, right? You really need to understand how each consumer is shopping, what's driving repeat purchases, et cetera. And so, without that data directly from the retailer, that can be incredibly challenging. There's different things that you can look at. I don't want to spoil too much. At some point, Pacvue will be releasing a new KPI. Really, in the coming weeks, we'll be releasing it, where we start to kind of allude to customer lifetime value. Riku, I don't want to steal the thunder, but maybe I'll let you kind of announce it here.
Yeah, we as a company, we're getting ready to roll out what's called repeat purchase ROAS, where we're looking at, trying to incorporate an element of customer lifetime value into your net present value of your investment. Meaning, yeah, that's great that if you're able to capture a shopper one time, right? But your investment looks a lot healthier if you're able to make the case that that person actually came back and bought your product again, right? You're getting the annuity. And that's an Amazon metric that we're going to get ready to launch. But even on Instacart, their team is able to give you metrics on what does repeat purchase frequency look like. And the data point that we love is by a customer's 10th purchase, roughly 20 to 25% of all purchases are coming from that past purchase list. So there's ways to kind of get at this. And there's, to Mindy's point, there's no perfect way to model out customer lifetime value. There's better ways than others, but it's all about aligning all stakeholders on making sure that everybody kind of agrees this is the company approach to this problem.
Yeah, when I was at Amazon, I actually was my last finance role. I was a senior financial analyst in the consumable space. So customer lifetime value, especially as Amazon was looking to turn that category profitable, was incredibly important. So I actually spent a lot of time doing a lot of customer lifetime value analysis back in those days. And to the earlier point, with a very robust data set, it's actually pretty interesting and easy to measure that. But as an external tool provider, we're leveraging the data points that we have available to at least start to move in that direction.
Excellent. Well, unfortunately, that is all the time we have today. If you have any follow-up questions, feel free to reach out to us. We're happy to chat one-on-one. But thank you so much, Mindy and Riku, for joining us today. Everyone on the call, thank you for joining our webinar. You can request a demo at pacvue.com, and we can dive into how we actually put a lot of these strategies into practice. And please do join us for upcoming webinars, pacvue.com/webinars, follow along pacvue.com/blog. This recording will email out and also be on YouTube later today. And if anyone wants to chat UFOs with me, feel free to reach out and we can always have a conversation about that. Thanks, everyone.
Thanks, guys.
Thanks.